There is this propensity for humans to really overestimate what's possible in the short term and underestimate what's possible in the long term.
The amounts of capital that we're talking about here are like pretty substantial. That could really make moves in DeFi. I mean, we're talking tens of billions of dollars.
Okay, institutional adoption is happening. Bessent is saying $3 trillion worth of stablecoins by 2028. Welcome back to the Rollup.
This is your home to learn from the biggest guests, the brightest minds at the tip of innovation.
Our goal is to help spread the collective knowledge of everyone in our community.
We are breaking crypto out of its echo chamber and taking it to the real world.
Sit back, relax, and enjoy it. All right, guys, welcome to the Rollup TV. Avi of Electric Capital and Mike from EtherFi. Guys, good to have you on. Mike, good to see you. Avi, first time on the show. Good to have you guys.
Good to see you. Thanks for having us.
Yeah, great to be back.
Mike's on his way to Singapore, guys. So if you hear a little bit of a ding ding in the back, he's on his way to shill EtherFi to the masses. Avi, it's your first time on the show, man. Quick intro about yourself, how you got into crypto, or kind of how Electric Capital formed, what your thesis is. Yeah, man, thanks for joining.
Yeah, absolutely. Thanks for having us. Yeah, my background, most of my career was an entrepreneur. I started and sold some companies, most recently to Facebook, and then ran some big teams there. And then started angel investing, and was fortunate to be involved with a bunch of companies that have gone on to do well in and out of crypto. So things like Notion and Figma and Airtable, kind of like more vanilla stuff. And then my co-founder Curtis and I, we were doing a lot of more out there stuff. So things like self-driving cars and supersonic airplanes and crypto. This is sort of like, and the crypto stuff was just the most interesting and weird and fun, and it reminded us the most of the internet, like the early internet when we were kids, and we were just too young to participate in a lot of the early internet stuff. And so we said, wow, this reminds us of the early internet. And the more we thought about it, the more we said, oh, this is potentially really transformative. Like if this really works, this changes the entire financial system, like the global financial system. And so we started spending more and more time on it. We were early investors in kind of that 16, 17, 18 era to a bunch of companies and protocols from that time. And a bunch of people started reaching out and saying, hey, what is this crypto stuff? You guys been into it for a while. We'd done some Bitcoin mining in like 2010, 2011. And so some folks here in Silicon Valley knew us, and they said, hey, what is this crypto stuff? Like, is Bitcoin real this time? You know, what's an ICO? Should we somehow be involved? That sort of snowballed into people saying, we don't really understand this crypto stuff at all. And it's different than what we do. You know, a lot of the venture investors here. And so they asked if we would manage their money too. And so kind of a bunch of the GP general partners at a bunch of these other VC firms started reaching out and just asking us to get crypto exposure. And so that's how Electric was started in 2018. And since then we've scaled it up. And so if you look at our like SEC filings, I think the last batch that we did, we manage somewhere around 3.5 billion at this point. So we scaled it up pretty nicely. We mostly, if you look at the investments that we do, mostly we do sort of early stage, you know, our typical sort of seed and Series A investor. So for a lot of the stuff we invested in, we've been pretty early. You can go look at the stuff we've invested in on our website. So that's sort of our bread and butter. Over the years, just by virtue of having been early to things like you know, ETH and Solana and a bunch of DeFi stuff, we've ended up with some good expertise on how to manage these assets on chain. And so this has turned into an interesting sort of strategy for us where we work with a lot of our portfolio companies to help them bootstrap and get off the ground, and do that in a secure way. And so we've increasingly been doing on-chain stuff for the last few years and trying to help protocols really just get off the ground. And so we do that now. We work with Mike and co on a bunch of projects, and ETHZilla, we're helping manage the assets there and try to drive those on-chain. I think we'll have some announcements coming up in the next couple of weeks that I think will help people understand kind of the scale of the possibility there. So anyway, that's a quick intro.
Beautiful. Yeah. It's good to have a venture capitalist who does things on chain. That's a good signal there. You know, there's quite a stigma against VCs sometimes. So glad that you included that part.
There's a lot of people out there calling themselves VCs that are not actually VCs.
Well, guys, so we have quite the kind of context happening right now. We're very firmly in token launch season, if you will, Q4, Q1. I mean, we are going to see a barrage of mainnet launches across the crypto sphere. We're also very firmly in IPO season. We saw Kraken announce a big raise a couple of days ago. We've seen the likes of Circle go live this year and have massive launches. And I saw one of Yano's posts This the full list of potential IPOs for 2026 is pretty insane. All that happening while treasury companies have been kind of really foaming at the mouth to get crypto exposure and buying billions of dollars of ETH, Bitcoin, Solana, and various other assets down the risk curve. All of that happening while altcoin ETFs are on the verge of getting approved by the SEC for the first time ever. The likes of XRP, XLM, Cardano, maybe not everyone's favorite coins, but these are the ones that are going to get approved most likely. This is the context that we have here in the landscape. Mike, starting with you, when you're looking at this from EtherFi's perspective, from the DeFi perspective, maybe we could just kind of zoom in a bit here. So this is like the macro context. What is happening on the micro? What are you seeing on chain? Where is the demand coming from? Maybe you can just give us a bit of a context for the on-chain ecosystem.
Yeah, there's not, aside from EtHZilla, which Avichal can talk about, there's honestly hasn't been a ton of impact on-chain from these various digital asset treasury companies. But I mean, I genuinely believe that it's coming, and the amounts of capital that we're talking about here are like pretty substantial. That could really make moves in DeFi. I mean, we're talking tens of billions of dollars that have been collected, I guess, by these digital asset treasury companies. And the big difference versus the ETFs, which are generally passive, I mean, at best they can stake some small portion of their ETH or SOL or whatever because of liquidity requirements. These DATs are actually able to do stuff with their with their assets. Now, certain DATs, like, and I may be wrong about this, but my current understanding is Bitmine has explicitly said that they're not going to do anything too exotic in DeFi or anything in DeFi at all. But others, more forward-looking ones like ETHZilla have said that they, in fact, have already done stuff. They've actually already deployed into DeFi, and I think that we're talking, there's tens of billions of dollars in ETFs, and if you can own something that's generating a yield of 5, 6, 7%. On the same asset versus owning something that is generating no yield, in fact, that has a cost associated with it. I mean, it's kind of a no-brainer that people are going to want to own the yield-generating assets. So I think this is huge. I mean, I would have thought that it would have kind of the floodgates would have already opened by now. But look, in the next 6 months, I think we're going to see some real fireworks.
Yeah.
Maybe I can add like 2 points of color there, plus one to everything Mike just said. One, I think on the ETF side, because you can't stake, you are essentially getting inflated away a little bit. I think this is going to change. If you look at kind of the direction the SEC is going in the United States, I think they're gonna have to allow staking at some point. It's just it's a benefit to the consumer. Even with that, I think because of kind of the way ETF redemptions work, like when somebody says I want to sell my shares, you got to sell the ETH on the back end. There's actually some like liquidity management the ETFs will have to do, and so that might mean that they can't stake 100% of their ETH, or if they do, they might have to use liquid staking tokens, or I don't know if the SEC will allow that, or they'll have to sell their staked ETH on like a secondary market, because the exit queue is on ETH, and eat some slippage. And so when you start looking at all those factors, I think it'll likely be the case just by the math of it that the ETFs will likely, and at least in the Ethereum case, not be able to produce the staking yields that you would be able to if you didn't have to deal with all that sort of liquidity constraints. It may be different, depending on kind of how like some of these other chains work. Like, if there were a Solana ETF, there might be some arguments that because of the way Solana block production works and MEV and yada yada, that actually might be able to be competitive on the staking. But strictly speaking, on the ETH side, I suspect the ETFs will be a little bit underperforming relative to the native staking yield. The other thing that I think Mike is getting at on the DAT side, where you do have tens of billions of dollars that's come in, one thing I think that's a little tricky, putting on sort of your DAT hat for a second here, is you would absolutely like to be able to go max risk and go generate all the yield that you can. And I think if you think that DeFi is going to have all these great RWA instruments and native DeFi instruments that can generate 10, 15, 20% yield, this starts to look really compelling, right? Like abstractly speaking, you're like, well, if you're sitting on $10 billion and you can generate 10% a year on this, you have a company that's worth $10 billion in assets that generates $1 billion a year in free cash flow. and you need like 12 employees, right? This is like an amazing business, right? This starts to look Berkshire Hathaway-ish, right? You're just spinning cash. So that's the promise of it. Now, the challenge is if you lose ETH, the market will really beat you up, right? So like the whole point is to have max ETH exposure with some additional yield. And so where you turn the dial on that risk exposure is really critical. And so I suspect what's going to happen here is some people like BMNR, right? Like we're just for disclosure, we're also investors in Tom Lee's thing, in the pipe. We're investors in SBET, Joe Lubin's, on the pipe. Like we're close to those guys and have a tremendous amount of respect for them. One challenge is once you're at that scale, once you're at 5 or 10 billion in ETH, you have to be really careful because so much of the value of your company is driven by the ETH price that if you lose any amount of ETH because there's a small contract bug or something, the market will really beat you up.
Yeah.
And B, it's hard to move the needle, right? I mean, like, could you today put $10 billion into DeFi and dramatically outperform base ETH staking yield, right? And how much work would you have to do to put 10 billion to work and really outperform? So I think there are like a couple of constraints in the short term that will sort of make it so that all this $10 billion doesn't come in at once. But I agree with Mike that like looking forward, as the risks come down, as the market becomes more comfortable with it, as these entities sort of build up a buffer, because if you're let's say a year into the business and you've been staking and doing some of the other less risky stuff in our opinion, like from the ETHZ side, you've now built a buffer. Like maybe you got 10, 20, 30 millions. And so if you lose $1 million in DeFi, it's like, it's not the end of the world, right? You're actually still dramatically outperforming staking. So I think like the willingness to go risk on will actually go up over time. We just need to let the companies sort of like build out some buffer of reserves and that they can eat into should there ever be a loss on the DeFi side. That's kind of my read on, I think, how that side of the market will play out over the next like 2 years.
Introducing Extended exclusively on Starknet, a next-gen perps trading platform live today. With 50 plus trading pairs from crypto to TradFi, you get the best experience on chain today. Deposit in the community vault for attractive returns, EMV compatible, and engage in unified margin, spot trading, lending, and perps trading.
Interesting. Yeah, I think it's interesting that you bring up Berkshire Hathaway because they have a specific workaround in their stock basically that allows them to, be an investment company under the Investment Company Act, I believe like 1940, where people are asking how, why can't we do DATs for stocks like Tesla stock, right? Yeah. Well, it's, you can't do that for securities, but you can for commodities. And so this is like a whole new kind of wedge here that smart people kind of figured out and have now created. And so I expect this to extend for a while, but kind of more on the points that they were making. And Mike, I'm curious how you see these effects. Avi, I'm not sure it's so black and white, right? Let's say there's 10 billion in ETH in these DATs. I'm not sure, ETHZilla or Tom Lee's Bitminer or SBET are going to go 100% or zero. I could see a world where it's 10% in Dollar, 10% into EtherFi, it's 10% into, and slowly kind of build it up, such, to signal to the market that they're actually taking care of their shareholders, but they're doing it in a strategic way. And so, Mike,
we can easily absorb 10 billion. I'll just put that out there to Bitmine.
Okay, Tom Lee, if you're watching,
Tom Lee, if you're listening,
all in on EtherFi. And so, Mike, what do you expect the knock-on effects to be to look like from the protocol level, right? Because all these people are valuing these assets right now, looking at their revenues, their TVLs, their growth, things all the way from Aave, Uniswap, Athena, Maker to EtherFi, Hyperliquid, Pump.Fun, et cetera. These are kind of really kind of forming what is looking like somewhat of the Mag 7, if you will, of crypto, slowly but surely. How do you think about the knock-on effects for EtherFi and for all the protocols mentioned as DeFi TVL rips past 1 billion finally? Or sorry, 1 trillion finally?
Yeah, I mean, I think it's going to be positive for sure. I mean, I'll make a note somewhat on the cynical side, maybe a little bit. I think this is changing, but DeFi today is still what I would call very Ponzi coded. Even when people are evaluating things in terms of fundamentals, they still see it through this lens of like, well, what does this mean in terms of the token price? Like, how does this work in terms of the tokenomics? There are, maybe 1 in 100 people in crypto or DeFi are actually thinking about like, have actually internalized what business fundamentals actually, are. That's starting to change. And I think things like revenue buybacks, like these things that are now starting to become a bit of a meta, and I think will accelerate, will over time act like a force of gravity on on the ecosystem, where anything that just doesn't have anything that does have it, and these are healthy businesses that are actually generating legitimate revenues, meaning not machine gunning tokens out the one side and then claiming some fraction of that as revenue on the other side. But I mean actual like legitimate businesses with gross margins and positive unit economics. These tokens are just going to, over a period of years, dramatically outperform anything else. But it's my unfortunate take is I think we're talking about years here. I think it's going to take a long time for people to rewire the way they approach these things. But I mean, on the positive side, certainly the ATs and everything else, and the whole stablecoin mania right now is bringing so much capital to work that that's just going to lead to a lot of innovation, lots of really cool projects having good runs as a result of it.
There's one thing we talk about on the venture side, which I've said on a bunch of podcasts over the years, but maybe in this context that Mike's talking about is worth reiterating, which is there is this propensity for humans to really overestimate what's possible in the short term and underestimate what's possible in the long term. And it's a side effect of how exponential growth works. Like our brains are not really wired for exponential growth. And so in the early days, when it is exponential, it's sort of sublinear. And at a certain point, it becomes like truly, truly crazy exponential, but we still think linearly. And so you get this effect where you like overestimate what's going to happen in the short term, but underestimate what's going to happen in the long term. And I think that's likely the case here with all of this DeFi stuff, which I agree with Mike. There's a lot of sort of Ponzi-nomics happening and the tokens are not sustainable. But really, like, when we underwrite an investment, we build these spreadsheet models and we're like, well, what do you have to believe about an EtherFi? Or what do you have to believe about an Aave? Or what do you have to believe about, some of these protocols that actually are durable. They're building something real. And you don't have to believe crazy things from like a cash flow and revenue perspective over 10 years to end up with like really interesting outcomes. It's just that you might be overpaying for 2 or 3 years, right? Or you might get punched in the face with the volatility for 3 or 4 or 5 years. But I think it's sort of like the market manifestation of this psychological phenomenon, which people really overestimate what's possible in the short term and really underestimate what's possible in the long term. And if you have the right time preference, you can essentially take advantage of that. Like if you're willing to be patient for 7 to 10 years and bet on the right things, that's why like long-term investing can really work, because the human psychology sort of prevents people from being able to do that most of the time.
Yeah. So Avi, just to follow up on that, then when you're looking at the landscape of DeFi, of the applications and of the tokens associated with them, is there a thought process that you're having or a mental model right now for, okay, institutional adoption is happening. Besant is saying $3 trillion worth of stablecoins by 2028.
Yeah.
The DATs are buying, IPOs are happening, all the kind of initial context. Are you looking at the application landscape today, like EtherFi, like others, and formulating theses around these tokens such that you want to be owning the direct tokens, which are going to be have their protocols be exposed to this institutional wave the most? Like, how are you selecting these assets to hold and be kind of a part of long term?
Yeah, it's an excellent question. It's a lot of what we do is trying to figure out how to figure out what's real. And by the way, nothing I say here is financial advice. Just, you should never, ever listen to me about anything, frankly.
Yeah, it's not like you created Google Maps or anything.
So yeah, just trust me, don't listen to anything I say. And if you disagree with that statement, go talk to my wife. So, the way we think about it is basically, is there a real fundamental human need that's being solved? And a lot of times you can kind of distill that down into a verb. Right. And so if there's like a verb and the thing becomes synonymous with a verb, then probably there's like some human need that's being met. And so Aave is lend, right? It's just like lending is a thing that humans need to do. I have assets, I need to borrow against them. You have money, like give me money and let me do something productive with my money. Trade is another one, right? And then you sort of zoom into that and you say, well, what are people trading? And you say, well, stable coins are a thing, to your point. And so how do stable coins move around? And what's the most efficient way for stable coins to move around? And so we kind of take it's almost like an ADIQ approach to it, which is like, what are like the really base things that people really need to do? And what are the things that they need to trade? And what are the things that are actually productive? And is there something actually productive happening underneath it? Right? Because if there's nothing fundamentally productive happening, then it is just a Ponzi flywheel, and the token will implode. But if there's some fundamental new value getting created, like somebody can take those assets and do something productive with them, then it's interesting. And today I think there definitely are some things like that. I mean, I think EtherFi falls into this. I think Aave falls into this. I think you could look at setting aside, again, this is a separate question than the tokenomics, right? Is the first question is, well, is it actually even useful? Like, great tokenomics don't bail you out of the thing not being useful. But something like Uniswap or Curve, right? Like there are real things happening. Fluid, right? These are like real innovations. They're really interesting things that are happening where people need to trade them, and you can look at the volume being real, right? It's hard when there are real fees being taken to manufacture volume, because why would somebody burn a lot of money? If there's actual fees being taken, again, the tokenomics enter here, right? If there's some sort of token emission that's subsidizing it, but that's where we start. It's just like, is there a fundamental thing here? And does the basic spreadsheet model get you to some sort of outcome where you can say, oh yeah, like once the market is fundamentally driven and rational, and that might take 5 or 10 years, but once the market is sort of rational in that way, which of these things are a really good buy? And I think if you think this way, which is really hard because you have to be willing to like suffer pretty big drawdowns along the way, this is what would lead you to, for example, invest in Facebook when it goes public, or this would lead you to invest in Amazon when it goes public, or Google, right? It's like you can look at the fundamentals of the thing and be like, okay, in the short term, people might overprice this or underprice this. But if you just look at the growth rates, you look at the network effects, you look at the real utility of the thing, and then you say, does that compound for 10 years? You can end up in a pretty good place. It's hard to do that though. It's if it were easy, then everybody would be rich, right? So it's really, really hard to do that. But that's how we think about it, at least.
Well, Mike, everybody needs to save money and everybody needs to spend money. EtherFi has been obviously crushing those two components.
Maybe two great verbs, right?
Yeah,
like
exactly.
Spend. This is like, these are massive verbs in the world.
Yeah, seriously. Yeah, Mike.
Yeah, for sure. No, I mean, I think I'm more excited about what we're building than I ever have. I think, when we started out, and maybe I'll make a small point. We started obviously with the staking product that a lot of people know us for, but this vision of creating the crypto native neobank or crypto native banking alternative was actually there. I mean, from 2 years ago when we first raised our Series A. I mean, we have a slide on it that. Somehow all of our investors, all 130 of them, have kind of amnesia. I think they saw it at one point, but it was such a ridiculous thing to say, I think 2.5 years ago, that like they were like, yeah, keep going with the staking thing. We don't care about anything else. But I think what we built is like, I mean, it's just legitimate. It's legitimately better than anything else that's out there. The example I like to give is that if we were a financial institution with 12 billion in assets and the kinds of volumes that we're doing, we'd need to have probably 4 or 5, maybe even 600 employees. Today, EtherFi has 30 employees, and so operating this kind of DeFi bank, as we call it, this crypto native alternative to a bank that gives you all the same services, is just over an order of magnitude cheaper than operating a similar kind of financial institution. And the reason for that is there's a multitude of reasons for it, but one, because we're non-custodial, the regulatory burden that we fall under is just substantially lower. It means we can just operate. We don't need to get banking licenses in 100 different countries. Second of all, we actually get a lot of stuff for free from the blockchain that other fintechs would have to build out. I mean, you'd have massive ops teams, much larger compliance teams. So it ends up being way cheaper to operate. And what that means is we can just give way more rewards to our users. So that's why we can give 3% cash back on the card. We can give much higher reward rates on people's savings and assets, and of course it's plugged into DeFi, and so you just get all these like really interesting opportunities that you wouldn't get anywhere. And so it's been huge. I mean, we're already just 3 months out from launching specifically our card program. I mean, we're by far and away the largest, on-chain card. I think we're like 3 times larger than the next one after us. But we're actually already larger than some of the exchange cards, for example, some of the CeFi, crypto cards. I think we'll be the largest within a couple of months. I mean, at the rate that we're growing. These days, we're doing over $1 million a day in transaction volume, which in crypto land payments, that's actually substantial. I mean, it doesn't really get interesting until we're about 100x that size. We need to be doing, I think, 5-10 billion a year before you can sort of really like credibly say you're a viable platform. But I mean, I think we'll get there, and I'm more confident of that than I ever have been. And I think that will be a demonstration, hopefully, among other things, that you can actually build really dramatically like powerful, durable businesses in crypto that you cannot do in TradFi. It's just physically impossible to build something like this in TradFi.
Yeah, Avi, I'm curious from the kind of investment perspective on this neobank concept, what you see is like how big could this get, right? Plasma just came out yesterday with their, or 2 days ago with their mainnet. This will come out next week, so it'll be kind of like last week. They announced a card and a neobank. Obviously, EtherFi has other competitors, but like the pie of the crypto users is like the main pie that everyone wants to get now because they're wealthy. But the real pie is like far larger than that. It's the whole world's population, basically. Avi, what is the how big do you think this could get from the investment perspective, and what are what made the timeline look like to achieve a larger outcome here, whether it be actual like the process or kind of how you think it might play out over like a chronological timeline?
Yeah. So actually, there's an interesting statement that you made there about, do you actually need to go to the rest of the world? And I think there's actually an argument that you don't. And the argument that you don't is that what you have, if you play this right, is the emergence of an entirely new capital base. So just to put some numbers against it, right? Like you look at Bitcoin today, you look at Ethereum today, you look at the stablecoin sort of dollar on-chain numbers today. And I think all of these numbers go up by like 10x. Like I think you go from 250 billion in stables to 2.5 trillion in stables. And I think those people are effectively crypto native. They could be all over the world, but sort of their first real exposure to any sort of financial services is likely a crypto wallet. If you look at just Bitcoin and ETH for a second, you could roll Solana in here, you could roll some of these other chains in here, but let's just look at those two for a second. And you kind of do the back of the envelope math. You're like, well, how many Bitcoin wallets have something like 1,000 BTC in them? And how many ETH wallets have, let's say on the order of, $50 million worth of ETH or $25 million of ETH, pick a number. And then you start applying forward multiples to these things. You're like, look, could Bitcoin get to $1 million if it's as big as gold? And could it get to a couple $1 million? I think it could be bigger than gold because now it's gold on a phone. Could ETH be at least as big as silver? Could it get to gold? I actually think ETH, there's an argument is better than gold, right? It's like for all the same reasons Bitcoin is better than gold. And these markets tend not to be like one person just wins, right? It's like there's Uber, but there's also Didi. There's also, right, you have, Grab. There's like these pretty big markets. So if you run the back of the envelope math on how many wallets have, let's say, more than 1,000 BTC, how many wallets have more than $25 million of ETH, and you put these forward multiples on it, what all of a sudden you realize is there's something like 5,000 to 10,000 such wallets that you can find. And if you get to those numbers, you have 5,000 to 10,000 new billionaires that were created entirely because of ETH and Bitcoin over the next decade. There's only 5,000 billionaires in the world, right? So that means like half the world's billionaires are crypto native billionaires in a decade, which is a really wild thing. I don't think people have processed this. This is like a tremendous upheaval in the power structure of society that like half the world's billionaires are because of one asset class. And this has downstream knock-on effects on everything, on politics, on governance, on family offices, like how the money flows of the world work. Like it has some pretty big consequences. So I think we just look at that and you say, okay, well, that's just the billionaires. That doesn't even count like all of the rest of the tail, right? Like how many new millionaires do you end up with? So I think there's an argument actually that this like capital market that's going to have several $1 trillion of dollars in it and potentially 20 to 50 $1 trillion of new wealth that's been created through the appreciation of the underlying assets, that in and of itself might be a large enough capital market that you never have to go, quote unquote, back to the real world. The analogy here would be, if you look at the internet, there was an argument that people used to make like 15 years about the internet of like, oh, like you get started on the internet and then you go mainstream, right? You get a TV show, you get a book, you get a movie deal. And actually what happened was the opposite, right? Like the internet just ate everything. And so the way it works now is you if you're a comedian, you want to get a Netflix deal, right? Or like you go big on YouTube and then you just monetize your own fan base. Like you don't get a TV show now. Like the world's biggest celebrities are, like Mr. Beast and iShowSpeed, and it's like Twitch and YouTube, right? And TikTok. And so I think the same thing happens with crypto. Actually, like the real market isn't that like, you know, the real world somehow shows up, I think what actually happens is crypto eats the rest of the world, and then everybody that actually has money is a crypto native.